Hi, I'm Eric Ogard, CIO of the Wealth Plan Group. Today I want to talk about alternative investments, which is a very broad, all-encompassing category of investments. Now, many times people hear alternatives and their mind immediately goes to hedge funds. And the term hedge fund is used as a catch-all basically for alternative investments, although that's not entirely appropriate. So today I want to have a broad-based discussion about alternatives, the roles of various different types of alternatives in portfolios, how we manage them at Wealth Plan with a particular goal in mind, and then finally wrap it all up for how we think alternatives will perform as a class over the long term and why they might be appropriate for your portfolio. Thinking of alternative investments, it's basically any investment that's not a listed stock or bond. Now, when a company goes through the process of listing a stock or a bond, there are certain criteria that need to be met, and those criteria provide assurances to the investing public that the stock meets or bond offering meets a certain set of criteria. So those are all intended to protect the individual investor from, let's call it, undue risk. When we think about a hedge fund, really, this is an investment vehicle that's been designed to get around securities regulation. And the way they do this is they're listed as a limited partnership or as a master limited partnership, and there are certain criteria for the investor to be involved that presumably make that investor more sophisticated. So there are two qualifications for investor types that might qualify for certain alternative investments. The first is an accredited investor, which is $1 million of net worth excluding the primary residence, or $200,000 in annual income, or $300,000 if considering a couple's income. The second level is something called a qualified participant or a qualified investor. And this is a minimum net worth of $5 million, and it opens up various other kinds of private investments that have a greater degree of illiquidity or otherwise different investment characteristics. So these investments tend to be the purview of ultra high net worth individuals, family offices, and institutions. And so that's broadly speaking what an alternative investment is, and specifically what a hedge fund is. Now, the first hedge fund was developed in the late 1940s in the United States. They became more prevalent in the 50s and 60s. There have been some very famous hedge funds out there, but ultimately this hedge fund moniker is, I think, somewhat misunderstood. What it's allowing the manager of the assets to do is to charge management fees and a carried interest in the trading profits, which in a normal registered investment under the Security Act of 1933 or 1940, you'll have investments that are regulated in terms of what can be charged. And so hedge funds fall outside of the purview of the regulations, and therefore they can charge very high fees. Another idea is that hedge funds have an illiquidity profile, meaning the terms of the investment in the hedge fund have all kinds of liquidity provisions that allow that manager to freeze funds, to not deliver funds, to do what's called gating funds by creating a queue for getting out with only a certain amount trading every dealing period, what it's called. They have notice periods that you have to give and to get your money out. There's a real protection of liquidity by the fund manager, and there have been some pretty famous cases where a fund manager will suspend redemptions, block them entirely, and continue charging a management fee. Sometimes that can be for the good of investor. But I think the idea is that hedge funds give far more leeway to the investment manager, whether it be fees or risks or liquidity, and the ability to control those things. If we step away from the idea of a pure hedge fund limited partnership, there are certain pseudo instruments, what we call interval funds. And so these are registered mutual funds that have more investor protections in them, but they have dealing windows, intervals, that are set up for putting your money in and getting your money out. And the reason funds want to do this is there's an underlying illiquid position, and if they allow daily trading, you can get that liquidity mismatch, which can be really challenging and just bad for investors. So oftentimes the real differentiator between an alternative investment and a listed stock or bond investment is that the alternative is illiquid or hard to turn into cash. Whereas, stocks and bonds, you can trade them intraday, mutual funds, end of day, ETFs, intraday. Far more liquidity profile in these listed securities than there is in private investments. Alternative investments run the gamut from stocks, bonds, private equity, private stocks, private bonds, private real estate, infrastructure, to name just a few. And then there are sometimes quite arcane strategies inside of hedge funds, either high risk strategies or illiquid or both. Now at Wealth Plan, we have a very specific idea for our clients of how we can prudently approach an alternative asset class. At the very highest level, when one engages in alternative investments, you're hoping to get something from that you can't get from stocks or bonds. That's either going to mean a higher return, or it's going to mean an improved portfolio outcome or risk reduction or portfolio efficiency. And we have found in surveying alternative investments that some of the quote unquote hedge funds are simply very aggressive forms of long only stock portfolios that have a high correlation to broad market indices. And our view is we can get relatively low cost exposure to the stock market through traditional norms, whether it be ETFs, mutual funds, or direct stock investment. No need to be paying 2 and 20 for a high beta stock portfolio, in our view. That leaves us with the things that are more low correlation or improving portfolio efficiency. And why this would matter: in periods like 2008, 2009, both stocks and bonds sold off. Then again, in the year 2022, when the Fed went on its rate increasing program, both stocks and bonds sold off. Now normally, and we've talked about this before here, you can count on sort of that yin and yang of stocks and bonds, so you have some countervailing performance when one of them is challenged. But on occasion, they'll both sell off. And this is why we want to have some exposure to the alternatives investment class. Now, when we do this for our clients, we're using daily liquid securities. We're doing this because that liquidity problem for most investors, when they experience it once, really don't want to have to go through that again. With limited partnerships that are highly concentrated in big illiquid positions, it can take literally years, depending on the size, to liquidate positions. So back in my CFA studies, there was a study done on the liquidity discount that you needed to apply to a private investment. Lots of studies with lots of different ranges, but on average, there's about a 35% haircut that can be justified for just a liquidity or an illiquidity discount, which is a very dear price to pay, and people that have gone through the process of trying to get their money out of it in a liquid investment understand, because the markdowns to get that cleared through the markets can be very high. So our focus is, let's deal with liquid investments only so we don't get into that liquidity trap. The second thing we think about is correlation, and we want to have almost no correlation to stocks and bonds, so that if we get into a period like 2022 or 2008, we have a portfolio that's chugging out returns irrespective of the kind of market that we might see for stocks and bonds. We also have what we call an absolute return orientation in these funds. So we want liquidity, we want low correlation, and we want an absolute return, which means we really don't want these things to have too much downside to them. Now, no investment is perfect, and anytime you have an investment, there's downside risk. That's kind of unavoidable. But we're trying to minimize the degree to which what we've built may go down. And the cost of that is it doesn't produce big returns to the upside. You could consider it to be a ballast, holding the portfolio steady when the winds blow or the seas get rough. And so the way we do this is only liquid investments that have a more absolute return orientation and a low correlation to stocks and bonds. That's not totally limiting. It's surprising what good you can do in a portfolio with that kind of a mindset in seeking investments. In our alternatives fund, we have a long-short equity portfolio. We have an event-driven equity portfolio. We have 2 commodity trading advisors that trade everything from currencies, financial futures, to grains and metals. We have a multi-manager commodity fund, and then rounding it out, we have an alternatives investment that's doing some private debt, private equity, those kinds of things. So very interesting lineup that allows us to improve our clients' portfolios, provide ballast, and help folks that want that kind of a return experience that doesn't include pure stock and bond investment. Something different, something smoothing in terms of the return experience, and something that hopefully will help them sleep better at night. So if you want to talk about alternative investments to any of our advisors, we've got plenty of those folks that would love to have the conversation. Reach out and let us know, and we'll put you in touch. Thanks so much.